What if every major financial crisis of the last 30 years followed the same hidden script? And what if that script is unfolding again right now, in real time, without most people noticing? This question is uncomfortable because it suggests something deeper than random market failures or reckless banks. It points to a structural pattern, a repeating architecture of deception, overconfidence, and delayed collapse that links subprime mortgages, the LIBOR scandal, the 2008 derivatives meltdown, the shadow banking explosion, and even the implosion of crypto giants like FTX. When you look closely, the narrative shifts from isolated frauds to a coordinated cycle of incentives that rewards manipulation until the system buckles under its own weight. This cycle always begins the same way. A new financial innovation emerges, promising safety, liquidity, or returns that seem just a bit too convenient. Subprime mortgages were marketed as risk distributed efficiently. LIBOR was trusted as a neutral global benchmark. FTX framed itself as the future of digital finance. Each of these innovations gained legitimacy because institutions wanted to believe they were stable. Investors, regulators, and rating agencies played along because the illusion of stability generated profit, and profit became the justification for ignoring warning signs. The frauds do not start large. They grow step by step as confidence expands faster than transparency. But here is the unsettling truth. The beginning of every fraudulent cycle feels like progress. It feels like growth, innovation, and opportunity. The early signals of manipulation are dismissed as noise. The market rewards participation, punishes skepticism, and celebrates the architects of the system as visionaries. And while money is flowing, while charts are rising, while everyone is winning, no one wants to ask the question that threatens the entire structure. What if the foundation itself is fake? When that question finally surfaces, it always comes too late. By the time the public begins to doubt, the cycle has already escalated into something systemic. And understanding how this escalation works is essential, because the global market right now is showing the exact same behavioral markers as previous collapses. We are no longer at the hopeful beginning of the cycle. We are deep inside its acceleration phase, and the cracks are becoming visible to anyone willing to look. Before we continue unfolding how the six-stage sequence functions and why the global market is already trapped inside stage 4, tell me what part of this pattern resonates with your experience. Leave a comment sharing your perspective. Hit the like button if you find this breakdown valuable. And take a second to check if you're already subscribed so you don't miss what comes next as we uncover where this cycle is truly heading. Every major financial fraud that eventually shook the global economy began as something almost invisible. A small distortion so subtle that even seasoned analysts dismissed it as harmless. That is the dangerous beauty of systemic frauds. They never introduce themselves as threats. They enter quietly, disguised as efficiency, innovation, or harmless optimization. Subprime lending started as a niche credit product for borrowers with weaker profiles. LIBOR manipulation began as tiny adjustments meant to smooth trading desks' daily operations. FTX started as a modest crypto exchange in an already chaotic digital market. None of them announced their intention to become trillion-dollar distortions. They grew because the system rewarded scale before integrity. At the beginning, frauds rely on a psychological pattern that repeats itself across centuries. When something new enters the market, investors want to believe it solves a problem. Subprime mortgages were sold as inclusive finance. LIBOR was celebrated as a universal benchmark simplifying global lending. Crypto platforms were marketed as democratizing access to wealth. These narratives are powerful because they offer emotional certainty in environments filled with uncertainty. People trust what sounds like progress, and institutions embrace what produces returns, even if they barely understand how the machine actually works. Slowly, the incentives shift. What begins as an adjustment or workaround becomes a habit becomes a practice becomes a norm. And once something becomes a norm, questioning it feels unnecessary or even foolish. Traders manipulating LIBOR did not see themselves as criminals. They saw themselves as operators doing what everyone else was already doing. Mortgage brokers pushing subprime loans believed they were simply playing by the rules of a booming market. Crypto exchanges misusing customer funds convinced themselves that growth justified shortcuts. The fraud doesn't feel like fraud to the people committing it, because each step is an incremental deviation rather than a dramatic leap. And as money flows, trust becomes the fuel that expands the machine. Regulators hesitate to intervene because early intervention risks destabilizing profitable sectors. Investors ignore inconsistencies because skepticism reduces returns. Large institutions adopt the same practices because they cannot afford to be left behind. Every layer of participation adds legitimacy, and legitimacy shields the underlying rot from scrutiny. By the time the system grows large enough to draw suspicion, it has already woven itself into the fabric of the market, influencing valuations, credit flows, and risk perception at a scale impossible to unwind cleanly. This is how individual misconduct evolves into a network, how a network evolves into a culture, and how a culture becomes an entire ecosystem of mutually reinforced deception. Not because people consciously conspire to build a corrupt structure, but because incentives guide them toward the same behaviors, the same shortcuts, the same rationalizations. The fraud matures into something self-sustaining, insulated by complexity and rewarded by momentum, long before anyone realizes they have built a system they no longer control. There is always a precise moment in every financial cycle when the truth becomes impossible to ignore. Yet the system continues forward as if nothing is wrong. It is the phase where spreadsheets still show growth, reports still appear optimistic, and institutions still reassure the public that everything is under control. But beneath that calm surface, the people closest to the machinery start noticing the irregularities. Analysts begin seeing numbers that don't reconcile. Auditors discover gaps that cannot be explained by normal operations. Traders notice liquidity behaving unnaturally, reacting faster or slower than it should. The signs appear everywhere, but the incentives to acknowledge them are weaker than the incentives to bury them. This is the psychological fault line where denial becomes a market strategy. When individuals inside the system recognize the distortions, but choose silence because speaking up threatens careers, bonuses, and reputations. Before every major collapse, you find emails, memos, or internal conversations revealing that people knew what was happening. During the subprime crisis, rating agencies whispered about the quality of mortgage pools long before the public understood. During LIBOR manipulation, traders openly joked about how fake the rates were. Before FTX collapsed, industry insiders questioned its balance sheet, but the social pressure to maintain optimism overpowered the instinct to warn others. It is never ignorance, it is selective blindness. And the market supports that blindness because markets are built on confidence, not truth. When an asset bubble is inflating, the belief in continued growth becomes a collective spell. Investors fear being the first to exit because early skepticism leaves profits on the table. Institutions fear sounding alarmist because panic becomes a self-fulfilling prophecy. Regulators fear disrupting stability because placing pressure on fragile structures can accelerate their failure. As a result, everyone pretends the system is sound, even as the inconsistencies multiply. The cycle survives through the silence of those who know better and the optimism of those who don't. But what makes this phase especially dangerous is that manipulation becomes normalized. The deceptive practices that were once small, isolated acts now appear justified. If tampering with benchmarks keeps markets stable, participants rationalize it as a necessity. If reclassifying risky loans as high grade keeps portfolios attractive, firms redefine it as innovation. If shifting customer deposits around creates the illusion of liquidity, companies call it strategic management. The moral line blurs, and once it is blurred, it rarely returns. This collective act of pretending becomes the bridge between manageable misconduct and catastrophic collapse. The data looks cleaner than reality. The liquidity appears stronger. The risk seems diversified. But stability created through illusion is not stability. It is the countdown phase before everything snaps. And by the time the public begins sensing that something feels wrong, the insiders have already made their peace with the deception, hoping the cycle can stretch just a little longer, long enough for someone else to face the consequences, when it finally breaks. There comes a point in every financial cycle when the illusion of stability finally cracks, and the market can no longer hide the truth behind polished statements or optimistic forecasts. Stage 4 is that moment when confidence, the invisible asset holding the entire structure together, starts evaporating from the inside out. It does not collapse instantly. It unravels slowly at first, the way a small tear in a rope begins to fray before the entire line snaps. Investors feel a shift in sentiment. Liquidity behaves strangely. Credit tightens, and institutions that once felt invincible suddenly appear fragile. The stories that justified previous growth begin to sound rehearsed, and explanations that once reassured the public now raise more questions than they answer. In Stage 4, fear spreads long before people are willing to admit it. The market becomes hypersensitive to minor shocks. A simple earnings miss that once would have caused a moderate dip now triggers a chain reaction. A regulatory comment that would have been dismissed as routine suddenly sparks volatility. Interbank lending becomes cautious as institutions quietly worry about counterparties they previously trusted without hesitation. The architecture of the system is still standing, but the foundation is trembling, and everyone close enough to feel the vibration knows what it means. What they don't know is how much time is left before the next fracture appears. And this phase becomes even more dangerous because rational behavior disappears on both sides. Institutions begin hoarding liquidity, not because they are failing in that moment, but because they fear what might come. Investors who once embraced risk now rush to de-risk their portfolios, creating the very instability they are trying to avoid. Analysts dig deeper into balance sheets and discover inconsistencies that were ignored in earlier stages. What once looked like creative accounting now appears like deliberate obfuscation. What once passed as tight management now resembles desperate improvisation. The narrative shifts from growth to survival, and that shift is impossible to reverse once it begins. Markets in Stage 4 behave as if they are trapped between two realities. On the surface, everything is still functioning. Exchanges operate, banks open their doors, and official statements insist that fundamentals remain strong. But beneath that surface, the system is absorbing pressure it was never designed to withstand. Every new piece of negative information accelerates distrust. Every attempt to reassure investors is interpreted as a sign of hidden weakness. Confidence does not decline linearly, it decays exponentially. What was once a whisper becomes a rumor, and what was once a rumor becomes accepted truth, even if no one can prove it yet. Stage 4 is the turning point where fraud, mismanagement, and systemic fragility transition from private suspicion to public awareness. It is the phase where markets begin asking questions that institutions can no longer afford to answer honestly. And once this stage begins, the cycle moves forward not because anyone wants it to, but because the trust that held everything in place has already dissolved, leaving nothing strong enough to slow the descent. If any part of this breakdown resonates with what you have seen in recent markets, share your perspective in the comments. Once a system enters its destabilization phase, the collapse does not happen because everything fails at once, but because a series of small, interconnected mechanisms continue operating beneath the surface, quietly accelerating the decline. These mechanisms are subtle, often invisible to the public, and rarely acknowledged by institutions that depend on presenting an image of control. Yet they are the real engine that transforms a fragile market into a cascading breakdown. At this stage, external shocks matter less than the system's internal behavior. The collapse becomes self-propelled. One of these mechanisms is the silent withdrawal of liquidity. Institutions that appeared healthy in the previous stages begin to reduce exposures, limit counterparties, and tighten lending criteria. None of this is announced publicly. It happens through routine operational decisions that, when combined, create a noticeable drying of financial oxygen. Market participants feel it before they understand it. Bid-ask spreads widen, overnight borrowing becomes more expensive, and the usual flow of credit slows to a crawl. This tightening creates stress not because everyone is failing simultaneously, but because everyone is preparing for the moment someone else will fail first. Another mechanism emerges through the behavior of information networks. Analysts who were previously optimistic begin to adjust assumptions quietly, revise projections downward, and release cautious, ambiguous statements that signal concern without triggering panic. But the collective effect is unmistakable. Institutions monitoring these signals begin to detect a shift in tone. Market models begin to price in higher volatility and deeper tail risk scenarios. Even without public declarations, the psychology of caution spreads through internal memos, trading strategies, and risk dashboards, shaping the behavior of thousands of decision-makers simultaneously. Then comes the regulatory lag, a critical force that unintentionally accelerates the collapse. Regulators often react slowly, not out of incompetence, but out of fear, that acknowledging the problem too early could destabilize the market. They request more data, conduct quiet reviews, and gather information behind closed doors. But during this period of silence, institutions interpret the lack of clarity as a sign of something deeply wrong. The absence of intervention becomes a signal stronger than any official statement. When the people tasked with monitoring the system appear hesitant, the participants inside the system brace for the worst. Meanwhile, the most fragile institutions begin taking desperate defensive actions disguised as strategic adjustments. They restructure liabilities, shift assets into less transparent categories, or sell portions of their portfolio at discounts too steep to ignore. These decisions ripple outward, triggering valuation adjustments across sectors that depend on relative pricing models. One institution's effort to stabilize itself becomes another's source of anxiety. The market begins to move not because of news, but because of interpretation, and interpretation becomes more powerful than fact. These mechanisms operate quietly, almost anonymously, yet together they create a downward motion no single actor can stop. By the time the public becomes aware that something structural is wrong, the internal machinery of collapse has already gained momentum, feeding on caution, secrecy, and the instinct for self-preservation that pushes every participant, knowingly or not, in the same direction. If financial systems collapse strictly because of bad numbers, flawed models, or mispriced risk, the world would have learned its lesson centuries ago. But the real engine behind every recurring crisis is psychological, not mathematical. It is the collective mindset that pushes institutions, governments, and investors toward the same destructive behavior, cycle after cycle, even when history has made the consequences unmistakably clear. The pattern is not accidental. It is rooted in the way humans interpret comfort, threat, and opportunity. And once this mindset takes hold, the path toward collapse becomes almost predetermined. The first element of this psychological pattern is normalization. When markets rise for long enough, people begin to internalize the idea that the current conditions are not just temporary, but structural. They convince themselves that high valuations, easy credit, rapid growth, and expanding liquidity are reflections of a new type of economy. Subprime lending was rationalized as financial innovation. LIBOR manipulation was excused as operational convenience. FTX's meteoric rise was interpreted as evidence that old rules no longer applied. Each narrative created the same illusion, that the cycle had evolved beyond the limits of past crises. Then comes the anchoring effect, a deeply ingrained cognitive bias that traps decision-makers in outdated assumptions. Even when the first warning signs appear, institutions cling to recent trends instead of adjusting to new realities. Governments assume the boom will continue long enough to justify more spending. Banks believe risk models must still be valid, simply because they worked yesterday. Investors assume that liquidity, once abundant, will always be available when needed. Anchoring blinds the system, making early intervention feel unnecessary and pessimism feel irrational, even as cracks begin to spread. The third element is competitive pressure. No institution wants to be the first to slow down during a boom. If one bank tightens lending too early, it loses market share. If one hedge fund reduces risk too soon, it underperforms peers. If a regulator acts aggressively, it risks political backlash for stifling growth. Everyone knows the system is stretching itself thin, but no one wants to be the first to act, because early caution is penalized while reckless participation is rewarded. Competition turns collective wisdom into collective denial. Then there is the moral licensing effect. When a system convinces itself that it is too sophisticated to fail, participants begin to justify behavior they would otherwise consider unacceptable. They tell themselves the risks are manageable, the models are accurate, the market is resilient. Small misjudgments accumulate, then compound, turning into practices that become normalized not because they are safe, but because they were not immediately catastrophic. By the time anyone recognizes the danger, the habits are too deeply entrenched to unwind without destabilizing the system. Finally, the most dangerous psychological force emerges: delayed recognition. The human mind resists acknowledging a crisis until the consequences are unavoidable. Governments assure the public that fundamentals remain strong. Banks insist liquidity is sufficient. Investors interpret negative signals as temporary noise. Everyone waits for more information, for clearer signs, for confirmation that the threat is real. But by the time confirmation arrives, the collapse is already accelerating, guided not by numbers, but by a shared psychological script that repeats itself every time the cycle turns. The most unsettling truth about financial collapses is that the most catastrophic frauds do not grow during chaos. They grow during stability. They flourish when the market is calm, volatility is low, credit is cheap, and institutions behave as if the risks of the past have been permanently defeated. Stability creates the perfect camouflage because it encourages complacency. When numbers look good quarter after quarter, people stop asking questions. When markets stop shaking, executives stop scrutinizing. And when returns feel predictable, investors silence their own doubts to avoid being the only skeptics in a world that rewards blind confidence. This illusion of stability becomes a shield for manipulation. Subprime assets exploded during years of booming home prices. LIBOR manipulation ran rampant during a period of steady interest rate expectations. FTX didn't emerge in a downturn, but in a euphoric crypto surge when everyone believed decentralization would rewrite the rules of finance. Stability creates the psychological distance that allows fraud to evolve from a minor adjustment into a structural deception. The smoother the surface, the easier it is to hide what is happening beneath it. Large systemic frauds also rely on the inertia of institutions. Once a market begins to move in a singular direction, organizations align themselves with that trend. Compliance teams loosen standards because violations seem unlikely. Risk departments pass models without stress testing them against extreme scenarios. Regulators shift focus to areas of political urgency rather than foundational vulnerabilities. Every layer of the system assumes someone else is watching, someone else is verifying, someone else is responsible. And in that vacuum of shared responsibility, fraud grows silently. Another reason stability is fertile ground for deception is that it attracts capital at a pace transparency cannot keep up with. During calm markets, money flows into products faster than due diligence can be performed. Investors rely on reputation, branding, or herd behavior, rather than forensic analysis. The assumption that everyone else is investing, so it must be safe, becomes its own justification. Under these conditions, even red flags look harmless. Instead of signaling danger, anomalies are dismissed as noise within an otherwise stable environment. What truly accelerates the spread of systemic fraud, however, is the emotional comfort that stability provides. People want to believe that the difficult chapters of financial history are behind them. They want to believe that innovations have solved old problems. They want to believe that institutions have matured. This desire is not rational, but it is powerful enough to override evidence, silence skepticism, and transform optimism into vulnerability. And because stability masks early warning signs so effectively, the fraud matures in plain sight, while the system drifts deeper into the cycle without realizing how compromised it has become. If this pattern of hidden growth during calm markets feels familiar to what you've observed in recent financial cycles, share your thoughts in the comments. When a financial system enters the later stages of its collapse cycle, the damage does not appear all at once. It unfolds in layers, moving from the abstract world of market signals into the concrete reality of everyday life. The first layer is mechanical. Prices begin reflecting stress that institutions have been hiding for months. At first, the shifts seem technical. Liquidity thins, spreads widen, volatility spikes unexpectedly, and assets once considered safe begin to behave erratically. The financial system tries to absorb this pressure quietly, but the mechanisms that once maintained stability now amplify weakness. Derivatives that were designed to hedge risk instead magnify it. Leverage, once a source of growth, becomes a multiplier of losses. The instruments built to sustain confidence start feeding the very forces that pull it apart. The second layer of consequences strikes the currency. Confidence in money is far more fragile than most people realize, especially when debt, liquidity, and institutional trust weaken simultaneously. Investors shift capital into safer assets, accelerating outflows that destabilize exchange rates. Governments intervene, but every intervention signals deeper fear rather than strength. A currency in distress can fall long before a crisis is officially acknowledged. Inflation spikes not because the public understands the collapse, but because the system is already compensating for lost stability. Prices begin moving faster than wages, and suddenly the crisis is no longer a market event but a national one. The third layer appears in credit systems. Banks tighten lending, not out of malice but out of necessity. Small businesses lose access to working capital. Households are denied loans they would have qualified for just months earlier. Corporations with previously unshakable credit ratings face increased borrowing costs. This tightening spreads quickly, because banks rely on one another for liquidity. When one institution hesitates, the hesitation infects the entire sector. Defaults rise. Restructurings multiply. Insolvencies that once appeared isolated reveal themselves as early warnings of a broader fracture. The fourth layer is psychological, and it moves faster than the economic data. Fear alters behavior before statistics confirm anything is wrong. Consumers start saving instead of spending. Companies delay hiring, investment, and expansion. Investors retreat from risk and seek safety even at the cost of returns. This psychological withdrawal deepens the contraction, creating a self-reinforcing cycle. What began as institutional caution becomes collective uncertainty, and uncertainty becomes the fuel of decline. The final layer is human. People feel the crisis not in charts, but in layoffs, rising prices, shrinking savings, and the disappearance of opportunities they once considered secure. Confidence, once eroded, does not return simply because the market stabilizes. It lingers as a quiet distrust that shapes behavior long after the immediate shock passes. And by the time the public fully understands the consequences, the system has already shifted into the next stage. Guided not by numbers alone, but by the cascading impact of decisions, fears, and reactions that accumulated long before anyone realized how far the cycle had progressed. Every financial cycle eventually reaches a moment when the crisis can no longer be understood through charts, yield curves, or credit spreads. This is the point where the system crosses an invisible boundary, and the damage becomes structural, reshaping the foundations that once held the economy together. At this stage, the question is no longer whether markets will recover, but whether the institutions, incentives, and frameworks that supported them can survive in their current form. The collapse stops being a matter of capital flows and becomes a matter of societal architecture. The first signal of this shift is institutional paralysis. Governments, central banks, and regulatory bodies, once confident in their ability to stabilize the system, begin reacting with visible hesitation. Policies that were once tools become gambles. Interest rate cuts lose their effectiveness. Liquidity injections provide only temporary relief. Stimulus measures no longer restore confidence. They merely slow the decline. The system is no longer responsive, and this lack of responsiveness reveals that the core fractures are no longer primarily economic but structural, rooted in years of accumulated misalignment between incentives and reality. The second signal emerges through the breakdown of coordination. Institutions that previously operated in sync begin acting defensively, each protecting its own survival. Central banks diverge in strategies. Governments prioritize domestic stability over global cooperation. Banks retreat into national barriers. What once functioned as an interconnected system fragments into competing interests. This fragmentation disrupts supply chains, complicates trade flows, and magnifies currency instability. The global market begins behaving less like an integrated network, and more like a collection of insulated islands, each struggling with its own version of the crisis. The third signal is societal absorption of the shock. Households, businesses, and communities begin adjusting to the new reality, not because they understand the mechanisms behind the collapse, but because the consequences are now shaping daily life. Job losses appear across sectors once considered stable. Households adjust spending habits in ways that reflect long-term caution rather than temporary worry. Companies begin redesigning operations, cutting projects, delaying expansions, and restructuring workforces. The crisis is no longer an economic disruption. It becomes a behavioral shift embedded in the decisions individuals make every day. And then there is the deepest signal, the erosion of belief in the system itself. Financial markets depend on trust, not only in institutions but in the rules that govern them. When people lose faith in those rules, the crisis transcends economics and becomes existential. Investors begin to question whether valuations reflect anything real. Businesses wonder whether credit will ever return to predictable patterns. Citizens question whether their savings, pensions, or jobs are secure within the current system. This erosion of trust is not loud or dramatic. It emerges quietly, as a collective recognition that the system may be unable to return to what it once was. By the time these structural shifts are visible, the crisis has already transformed into something deeper, something that cannot be undone through stimulus or temporary intervention. The system is not just damaged, it is changing form, pulled forward by forces set in motion long before the public realized that the cycle had reached its irreversible phase. The final stage of the financial cycle is the one that institutions, analysts, and policymakers rarely discuss openly, not because they lack the data, but because acknowledging it would require admitting that the system has moved beyond repair. Stage 6 is not a sudden collapse. It is the quiet acceptance that the old framework can no longer sustain itself. What follows is a reordering, a slow but irreversible shift in how capital moves, how power is distributed, and how societies understand economic stability. The transformation is not announced by a single dramatic event, but revealed through a series of subtle changes that accumulate until the new reality becomes impossible to deny. In this stage, markets no longer respond to traditional interventions because the assumptions that once supported those interventions have disintegrated. Monetary policy loses its influence as interest rates, even when manipulated, fail to steer behavior. Fiscal policy becomes reactive rather than strategic, focused on limiting damage rather than shaping growth. Global coordination weakens. Further, not by choice, but by necessity, as nations prioritize internal stability over external alignment. The system fractures into regional blocks, each with its own rules, currencies, and power structures. What was once considered a unified global economy becomes a landscape of competing economic models. But the deeper disruption happens beneath the surface, in the way people recalibrate their expectations. The belief that markets naturally recover, that institutions will always intervene, successfully, that currencies remain stable by default. These assumptions erode slowly, leaving behind a population that becomes more cautious, more skeptical, and more aware of fragility. This shift in collective psychology is what truly reshapes the world after a systemic collapse. People adapt not by choice, but because the signals around them make it clear that the previous cycle is no longer returning. Industries reorganize. Businesses redesign themselves to survive prolonged instability. Investment strategies that once relied on predictable cycles are replaced by approaches designed for uncertainty. Even cultural values shift, placing greater importance on resilience, security, and diversification, rather than growth at any cost. And as these adjustments ripple outward, the new system begins forming, not as a planned structure, but as an organic response to the failures of the old one. By the time most people recognize that a new era has begun, they are already living inside it. The previous cycle has ended, not with a single collapse, but with a transformation so gradual that it feels almost natural. And yet, every major crisis in history has followed this same trajectory: denial, escalation, destabilization, structural failure, and finally, reorganization. What comes after Stage 6 is not simply recovery, it is reinvention, a quiet rewriting of the rules that will shape the next generation of financial behavior. If you reach this point, you already understand more about this cycle than most people ever will. If this journey clarified something for you, leave a comment saying, "I see the pattern now." Hit the like button if the breakdown resonated with you. Make sure you're subscribed so you don't miss what comes next. And when you're ready, there's another video waiting that expands on these ideas. Just click and continue the exploration with me.